Hey everyone, and thank you for joining us today. I'm Mike Mentor, Chief Investment Officer with Financial Synergies, and welcome to our Q2 2026 quarterly market and economic themes webinar. Of course, we do these every quarter, and I have to say, this one comes at a particularly interesting time. First quarter of 2026 was one of the most eventful quarters we've seen in a while. We had a new Fed chair nomination, a meaningful shift in market leadership, an AI-driven sell-off in the software sector, and in a geopolitical shock that sent oil prices surging to $100 a barrel, actually over $100 a barrel. So a lot happened in 90 days, and today I want to walk you through all of it, which, what it means for the economy, what it means for your portfolios, and what we're watching most closely as we head into this second quarter, which obviously we're now in. I apologize, I'm a little under the weather, guys, so if I seem sniffly, that's the case. We have a lot to cover here. So as always, we've organized this presentation around 10 market themes, and I'll take you through each one. The goal is to give you context and perspective, not just headlines, but the actual analysis behind it. So let's get into it. What you're looking at here is a chart of the S&P 500 from the end of 2025 through March 31st, with major events of the quarter, annotated along the way. It tells the story of a quarter that started with real optimism, but ended with real uncertainty, clearly. And the path in between was anything but smooth. Let me walk you through the what I think are three distinct chapters of this past quarter. Chapter 1, January's rally. S&P began the quarter near 6850 and spent most of January climbing. Market leadership broadened in a way we hadn't seen in a while. Small caps were outperforming, value stocks were gaining ground. The Russell 2000, which is small caps, actually hit an all-time intraday high on January 22nd. There was a brief sell-off on January 19th tied to tariff threats related to Greenland, but equities recovered within days. Investor optimism was running high, fueled by their Fed rate cuts in late 2025. Expectations for continued economic growth and a wide valuation gap between mega cap growth stocks and the rest of the market. By the end of the last week of January, the S&P 500 was briefly touching 7,000, which was an all-time intraday high. The Fed held rates steady at its January 28th meeting, and Kevin Warsh was nominated as the next Fed chair, an event worth watching as it signals a potential shift in the Fed's approach down the road. Let's head into chapter 2 now. February's disruption. The mood changed quickly at the start of February. A series of AI product launches demonstrated that general-purpose AI tools could perform tasks previously handled by specialized expensive software at a fraction of the cost. So the market's reaction was relatively swift and severe. Software stocks fell first, then the selling spread to financial data providers, logistics companies, real estate services, and beyond. And the S&P 500 pulled back roughly 2.5% from its late January highs. In the initial wave, at least. It did recover briefly, then sold off again as AI disruption fears intensified. But later in February, the Supreme Court struck down the administrative's tariffs, which removed one source of uncertainty and briefly lifted the markets, but the relief was short-lived, and because the third chapter was just beginning, which we'll touch on now. So chapter 3 is, of course, the Middle East. In the final days of February, the U.S. and Israel launched military strikes on Iran. The Strait of Hormuz, which is a critical choke point handling roughly 20% of global oil flows, was closed to commercial shipping. And oil prices surged from the mid-60s to nearly $120 a barrel at their peak on March the 9th. And stocks fell hard as investors began pricing in the economic consequences of a prolonged energy shock. Iran's newly appointed supreme leader declared that the strait would remain closed, pushing back oil near the $100 mark and keeping markets under pressure through most of the month. The Fed held rates steady for a second consecutive meeting in March. And by that point, the conversation had shifted from how many rate cuts in 2026 to is a rate hike on the table at all. The quarter bottomed on March 30th and rallied sharply on the last day after Iran signaled a willingness to end the war, but the recovery wasn't enough to erase the damage. The S&P 500 finished the quarter near 6,500, and that was down approximately 4.5%. The quarter began with stocks setting new highs and ended with the rising uncertainty around oil, inflation, and the path of Fed policy. And really, those three themes, the Middle East, AI disruption, and the Fed, they're the threads that run through everything we're going to talk about today. AI disruption. Let's get into this a bit. So, software sell-off and the importance of diversification. This is the slides we're looking at. There's two sides to this: the left, right, and the left side and the right side. This slide on the left focuses on one of the quarter's most consequential stories, the AI-driven sell-off in the software industry. And it's one I want to spend a little time on because I think it has real lessons for how we think about our portfolio construction. Let me start with the context. And we touched on this earlier, but the software industry actually started declining back in October, and it was already down about 8% in the fourth quarter, even as the broader market was roughly flat. But the sell-off accelerated in late January and early February after a series of AI launches demonstrated that these tools could replace tasks that had previously required specialized software. So the market's reaction, and we covered this earlier, but it was decisive. I mean, as of March 31st, the S&P 500 software and services index was down nearly 30% from its October peak. That's a significant drawdown. And again, we're looking at the chart on the left right now. But to put this in historical context, this chart ranks the current sell-off against every major software drawdown over the past 30 years. What you see is that this is one of the largest non-recessionary software drawdowns on record, larger than the COVID pandemic's roughly 26% decline. The only episodes that exceeded it were the dot-com bust, which saw a 71% drawdown, and the 2008 financial crisis at 53%. And both those happened during recessions, so when corporate earnings were declining broadly and businesses were cutting spending. This time, the economy is still growing and earnings are rising. So this is a valuation and disruption story. This is not a recession story. So now let's take a look at the chart on the right. Here's the part I want to highlight for you, specifically. So this chart tracks three things since the start of the fourth quarter. The software industry in dark blue, the broader technology sector in light blue, and the S&P 500 in gray. The gap between those lines tells you everything. The software index is down 30%. The broader tech sector is down about 8% and far less severe because it includes semiconductor, hardware companies that actually benefit from AI spending. And the S&P 500, well, it's down roughly 2% over the same period. So what felt like, from the headlines, like a broad market catastrophe was in reality highly concentrated in a specific corner of the market. Diversified portfolios absorbed this disruption without significant damage. And that's not an accident. That's diversification working exactly as it's supposed to. If a portfolio had been concentrated in software stocks or high growth tech, specifically, the experience would have been pretty painful. If it was diversified across sectors, factors, geographies, the experience was far more manageable. The broader question of how AI will ultimately reshape the software industry and many others is genuinely unresolved right now. We don't know. The market's still working through it, and we expect this theme to remain a source of volatility as AI models are released and companies begin to formulate their responses. It'll be one of the defining investment themes, I think, of the next several years. We'll talk more about that as we get into these next slides. But for now, I'll say this. Excuse me. The software sell-off was one of the catalysts that drove a meaningful change in market leadership during the quarter. And that's what we're going to look at here next on this next slide. So this has to do with market leadership and factor rotation, and it's leading to broader participation. This slide compares 6 major U.S. equity indices since the start of the fourth quarter of 2025. So they're all indexed to 100 on September the 30th, so you can compare them on equal footing. The 6 indexes are the S&P 500, the S&P 500 Growth, the S&P 500 Value, the NASDAQ 100, the Russell 2000, and the equal weight S&P 500. Tracking all 6 on one chart tells a story about where money was flowing during the quarter, and the story is a notable shift in market leadership that has some real investment implications here. For most of the period from 23 to 25, a very narrow group of large cap growth and mega cap tech companies drove the majority of the market's return. The cap-weighted S&P 500 was outperforming its equal-weighted version by the widest margin since the dot-com era. You had a handful of companies doing the heavy lifting for the entire index. And you remember the Mag 7 and all that stuff. That dynamic started to reverse in Q1. You can see in the chart that in early in the quarter, the Russell 2000 surged. And at one point, it was up nearly 10% from the start of Q4, significantly outpacing the S&P 500. Value stocks also moved higher, and the equal weight S&P 500 outpaced the cap-weighted version. So this is what we call broad participation. Returns being driven by a wide range of companies rather than concentrated group at the top. But several things fueled this rotation. The Fed's rate cuts in late 2025 provided a relief to rate-sensitive smaller cap companies, and the valuation gap between large cap growth and the rest of the market had become quite wide, creating an opportunity for this mean reversion. And investors were expecting continued economic growth in 2026. All of that pointed toward the same destination, capital rotating out of expensive mega cap growth names and into value, small caps, and equal weight strategies. So this rotation continued into late February, aided by this AI disruption sell-off, which hit, again, software and tech companies hardest, and sectors that are disproportionately represented in growth-oriented and market cap-weighted funds. But the backdrop shifted in March when the geopolitical conflict triggered a broad risk-off move. In that environment, large cap growth and the NASDAQ held up better than small caps and value, which is often the pattern when investors are looking for perceived safety. So where do we end up at the end of the quarter? Value is still leading growth by roughly 8.5% since the start of Q4, and the Russell 2000 is still outperforming the S&P 500 by roughly 5%. So the rotation hasn't reversed; it's just been a little interrupted here. So the question, heading into this second quarter is whether the fundamental and valuation case for broader participation reasserts itself once the geopolitical dust settles. I think it can. The rotation was building on solid ground before the conflict began, and a sustained broadening of market leadership would be a healthy sign, be a good thing. It means returns are being driven by the fundamentals of a wider set of businesses, rather than the momentum of a narrow few. So we'll be watching this closely. Let's talk about economic activity. So as we shift from market dynamics to the underlying fundamentals of the economy, because amid all the noise from geopolitics and AI, the economic data has been pretty encouraging, despite what a lot of people think. This slide looks at the ISM Purchasing Managers Index, which we watch fairly closely. It's one of the most timely and reliable indicators of business activity. For those less familiar, the PMI is a survey-based measure. Readings above 50 signal expansion, and meaning businesses are growing. Readings below 50 signal contraction. And so the chart tracks both manufacturing PMI and the services PMI from the end of 21 through February. So let me start with services, the light blue line. Services have been the backbone of the U.S. economy for the past 3 years. Consumer spending on healthcare, travel, financial services, and tech has kept the services sector in expansion territory for virtually this entire period. It's only dipped below 50 twice since early 23. In February 26th reading of 56.1 is the strongest we've seen since late 24 and the highest since July of 2022. So the services economy is on solid footing. And that matters because services account for the majority of our U.S. GDP. Now, the manufacturing story. So this is the dark blue line. It's very different. And this is where the news has been genuinely surprising, I think, to the upside. Manufacturing has been in contraction for most of the past 3 years. By our count, spent 34 of the prior 38 months below the 50 line. So contracting. The Fed's aggressive rate hikes, rising input costs, and weakening global demand all weighed on the industrial sector. There was a brief touch of 50 in early 25, but manufacturing slipped back below for another 10 months after that. So I want to be transparent about that, about that context. But here's what's different now. In January, manufacturing PMI rose to 52.6. In February, it held steady at 52.4. So these, they're back-to-back months in expansion territory since late 2022. And unlike the early 25 episode, these readings are meaningfully above the 50 line, not just touching it. They're well above. So the follow through in the second month is important. It suggests this is more than a 1 month blip. For the past 3 years, U.S. economic growth has been almost entirely a services story. Manufacturing's potential return to expansion signals a broadening of economic activity, more of the economy contributing to growth at the same time. That's a positive development. And if it holds, it's supportive of the earnings picture we'll discuss in a few slides here. The question heading into Q2 is whether manufacturing can sustain this momentum or whether it fades like it did in early 2025. So we'll be watching the PMI readings closely. Let's turn our attention to oil prices and the historical context and implications for the economy. So oil prices are arguably the single most important variable driving the markets right now. So I want to spend a little time on this slide. What you're looking at is WTI crude oil going back to 2006, 20-year view. So this gives us the historical context we need to understand, where we are today. The inset chart in the upper right zooms into I don't know if you can see that, but it zooms in to show how the move unfolded during the quarter. Let me start with the long-term picture. Over the last 2 decades, oil prices have experienced several major spikes. WTI hit $140 a barrel in mid-2008, traded above 100 for an extended period from 2011 to 2014, and spiked above 110 in 2022 after Russia's invasion of the Ukraine. In between those events, oil experienced long stretches below $80, including drops below $40 in 2009, 2016, and again during COVID in 2020. So the historical average over this full period, 20 years, is $73 a barrel. And today, with oil near 100, we're roughly $27 above that long-term average. And this marks only the fourth time in 20 years that WTI has traded, near or above the $100 threshold. So now let's look at how we got here. So again, kind of looking at the inset chart there, oil started 2026 around $57 per barrel and traded in a relatively narrow range through mid-February, gradually climbing into the low 60s. Then the conflict began. And in late February, as the Iran-U.S. conflict escalated and the Strait of Hormuz closed commercial shipping, prices, they surged. So let me put this straight into context for you, the Strait of Hormuz. It handles roughly 20 million barrels of oil exports per day, which represents, again, we touched on this, but it's around 20% of global oil flows. So its closure is the largest physical supply disruption since the 1970s. It's not hyperbole, this is a fact. So prices surged from the mid-60s to nearly 100 in a matter of weeks. The International Energy Agency announced a record 400 million barrel strategic reserve release to try to stabilize markets. And while that helped temporarily, prices rebounded. The market's message was clear. Reserve releases can bridge a short disruption, but they can't substitute for actually reopening the strait. So what does this mean for the economy? The surge in oil has immediate and direct consequences. National average gasoline prices have risen nearly $1 per gallon since late February. And that functions as a tax on consumers and businesses. And it reduces purchasing power, compresses profit margins, especially in energy-intensive industries, and adds to inflationary pressure at a time when inflation was already running above the Fed's 2% target. There's also a bifurcation worth noting here. A geopolitically driven oil shock is very different from a demand-driven one. When oil rises because the economy is booming and everyone wants more, that's a sign of strength. When it rises because the strategic choke point is closed, that creates what economists call a supply-side inflationary shock. Prices go up, but economic growth stalls. That's a trickier situation for policymakers and for the markets. So the path forward depends heavily on the duration. If the strait reopens in the coming weeks, forecasters project oil could, fall back towards the 70s by mid-year, limiting the economic damage. If the closure extends through Q2 and into the summer, elevated energy costs could meaningfully weigh on consumer spending, corporate margins, and the Fed's ability to cut rates. So we're watching this very closely. It's not exaggerating to say it's probably the single variable with the greatest potential to change the outlook across, really every other theme in this presentation. And that brings us to another major issue is inflation. So here we're looking at our inflation monitor. It's update on inflation trends. We have two sides here. Obviously, we're chart on the left and the goods and services chart on the right. The oil shock makes this inflation slide more consequential than it probably would have been even a few months ago. So I want to walk through it carefully. It's a two-part picture that tells you both where inflation stands today and where the remaining pressure is coming from. So looking at the chart on the left, this shows headline PCE and core PCE on a year-over-year basis back to 2017. So PCE is the Personal Consumption Expenditures Index. It's the Fed's preferred measure of inflation, and it is what really drives their policy decisions. Headline PCE peaked near 7% in mid-2022. Core PCE, which strips out food and energy, peaked near 5.5% shortly after. But both fell steadily through 2023 and into 2024 as supply chains healed, energy prices stabilized, and the Fed's rate hikes worked through the system. That progress was real, and it was meaningful. But the descent slowed noticeably in late 2024 and has since basically flatlined. As of the January 2026 reading, the most recent, headline PCE sits at 2.8% year over year. Core PCE ticked up to 3.1% from 3% back in December. And so the monthly numbers are mildly concerning. On a month-over-month basis, core PCE rose, 0.4% in January. That's the hottest monthly print in some time, with an annualized rate running near 4.5%. If that trend holds, the 12-month number could start moving the wrong direction in the months ahead. That's the what. Now let me show you the why. Now we're looking at the chart on the right. This chart breaks the inflation into its two major components. We have goods prices and services prices. The good story, the dark blue line, is actually a good news story. Goods inflation surged above 10% year over year in early 2022 during the pandemic-driven supply chain disruptions. And that wave has fully resolved. Goods spent much of 2023 and into 24 in outright deflation. actually falling on a year-over-year basis and have since stabilized to around 1.3%. Goods have done more than their share of the disinflationary work. The problem is services. So this lighter line peaked around 6% in late 2022 and came down more than gradually. But the descent stalled at roughly 3.4% in the second half of 2025, and the January reading ticked up to 3.5%. The primary culprits are categories that are relatively insensitive to higher interest rates: insurance premiums, medical care services, and specialized professional services. These aren't areas where raising rates has much direct impact. So, excuse me, here's the Fed's dilemma. Goods have normalized, and they're no longer providing a disinflationary tailwind. So the entire burden of getting inflation back to 2% now falls on services. And that's exactly where progress has stalled. So there is one encouraging offset, and that's shelter costs, which are the single largest component of services inflation. And they recently posted one of their smallest monthly increases since 2021. So if shelter continues to normalize, it could provide meaningful relief. But the question is whether that's enough to overcome, the stickiness in insurance, healthcare, and other, labor-intensive categories. And then there's the oil wild card. The inflation data you see on this slide, it runs through January before the conflict. So, rising oil prices feed directly into headline inflation through gas and energy costs, and they, indirectly affect prices across the economy. There's a real risk that headline inflation, which is currently at 2.8%, moves back above 3% as the oil shock works its way through the data. So that would further complicate the Fed's already difficult position, which is exactly what we're going to turn to on this next slide. We're going to talk about interest rates. So one of the most dramatic shifts of the quarter wasn't in stock prices. It was in the interest rate expectations. So this slide tells that story. What you're looking at is the federal funds rate from early 2021 through today, with the shaded area on the right representing the market's forecasts for the remainder of 2026. There are two forecast lines. The solid dashed line is the current market expectation as of quarter end. The dotted line is where expectations were just 1 month earlier at the end of February. Let me give you the brief history. The Fed started aggressively hiking rates in early 2022 in response to surging inflation. So from March 2022 through mid-2023, rates rose by more than 5 percentage points, one of the fastest tightening cycles in modern history. The Fed held rates at that elevated level for over a year and then began cutting in September of 24. And since then, it's reduced rates by a total of 1.75%, bringing the target range down to 3.5 to between 3.5 and 3.75%. So it held rates steady at both its January and March meetings this year. And the tone from Fed Chair Powell has shifted. So the committee is communicating patience now, not urgency to cut further. Now, look at the forecast window. So this is the shaded area on the right of the chart. Here's where the quarter's drama really shows up. As of the end of February, the dotted line shows the market was pricing in a policy rate near 3.05% by year end. That implied roughly 3 rate cuts, still consistent with the rate cut narrative that many investors were counting on. Fast forward to March 31st, and the dashed current forecast shows the market expects the Fed funds rate to end the year around 3.56%, only slightly below where it sits right now. So that means the market has gone from pricing in 3 rate cuts to pricing essentially 1 or possibly no rates cuts. So what caused that dramatic repricing? So there's 3 things that converged. First, U.S.-Iran conflict, obvious, sent oil prices surging, raising immediate concerns about energy-driven inflation, rightly so. Second, the Fed itself revised its 2026 inflation forecast higher at the March meeting, an acknowledgement that the path back to 2% is harder than expected. Third, Fed Chair Powell's tone at the press conference was cautious. The committee wants to see more progress on inflation before cutting rates further. So the market read those signals clearly. The shift from when will the Fed cut to will the Fed cut at all in 2026 has real implications for investment portfolios and for the broader economy. So higher for longer interest rates weigh on homeowners with adjustable rate mortgages, on small businesses that depend on credit, and on companies carrying floating rate debt. They also keep bond yields elevated, which has income implications for fixed income investors. That said, I want to offer some perspective here. The Fed is being cautious, not alarming. Its latest projections still show one rate cut this year. GDP growth was revised slightly higher at the March meeting, and the unemployment forecast was unchanged. So this isn't a scenario where the Fed is emergency hiking or signaling recession. It's a scenario where the Fed needs to see the oil price situation resolved and inflation continuing, to make progress before it acts. If the Middle East conflict is resolved and oil normalizes, the rate cut scenario could come back into view in the back half of the year. We'll see. But if inflation remains elevated or rises, we may end 26 at roughly the same rate level we started. So either way, the path is much more uncertain than it appeared in January. That's for sure. Let's talk about fixed income real quick. So I want to take a moment here to take a look at the credit markets because they do give us some of the clearest signals about how the financial system as a whole is absorbing the current environment. So this slide focuses on the high yield credit spread, which measures the extra yield that lower rated corporate bonds pay above comparable U.S. Treasury securities. So think of it as the market's real-time assessment of corporate health and default risk. When credit spreads are tight, the market is confident that companies can service their debt. When they widen, it signals growing concern about the economic outlook and potential credit stress. So the chart makes this pattern vivid. Spreads spiked to over 10% during both the dot-com bust and the energy crisis of 2015 and 2016. They surged to nearly 20% at the height of the 2008 financial crisis. A genuine, systemic event. They approached 9% during the COVID shock. And so between those crises, spreads have generally ranged from about 4 to 6% with a long-term median around 4.5%. Today's reading is 3.28%. So the inset chart here shows how we got here over the past 15 months. Spreads started, 2025 near cycle lows around 2.6%, reflecting an extremely benign credit environment. And they briefly spiked to 4.6% in early April as trade policy uncertainty rattled markets, then tightened back into the high 2% range as trade deals were reached and the global economy stabilized. They were near those levels, low levels, heading into early 26, and then the oil shock arrived. So spreads widened from around 2.85 to 3.5% in just a matter of weeks as the U.S.-Iran war escalated. So let me put the 3.28% in context for you. Yes, it's above cycle lows, but it's still well below the 4.5% long-term average, and it's nowhere near the 5% or higher levels that have historically signaled systemic credit stress. So the widening has been rather orderly. It reflects the market repricing risk in response to geopolitical uncertainty, higher energy costs, but it's not a fundamental breakdown of corporate creditworthiness. Companies are not in financial distress. Earnings are still expecting to grow. The credit market is telling us this is an elevated uncertainty environment, not a crisis environment. So the path from here depends on the same variables that's driving everything else, how long the conflict is going to last. So if the Strait reopens and oil normalizes, history suggests spreads would tighten fairly quickly. We saw exactly that after the tariff-related widening in April 2025. If the conflict persists and energy costs remain elevated, higher input costs could weigh on corporate margins and push spreads wider. It's a metric we're tracking closely. We'll be watching for, any signs of more significant deterioration. Let's take a step back here. So we want to zoom out now and address what I suspect is a question on a lot of minds. If the market is falling, does that mean something is fundamentally wrong with corporate America? And the short answer is no. And this chart explains why. On the left, this chart compares the S&P 500's price level against its rolling 12-month earnings per share going all the way back to the year 2000. Over that 26-year period, the two lines have moved together with a 96% correlation. That's an extraordinarily tight relationship. When earnings grow, stock prices tend to grow with them over time. And when earnings contract, as they did during the 2001 recession, in the 2008 financial crisis, and also in the COVID pandemic, stock prices fell with them. So here's what stands out about the current environment. Earnings have continued to rise even as the S&P has pulled back roughly 6.5% from its record high in late January. The two lines are diverging near term in a way that signals the market is actually getting cheaper on a fundamental basis. So the forward PE ratio, what investors are paying per dollar of expected earnings, has fallen from approximately 22 times at the end of 2025 to roughly 19 times at the end of Q1. That's a meaningful compression in valuation. So the sell-off has been driven by a repricing of risk in response to geopolitical uncertainty, not a deterioration in corporate fundamentals. Now look at the chart on the right. This tracks Wall Street's consensus earnings estimates for each quarter of 2026, Q1 through Q4, and how those estimates have evolved since September. The Q1 estimate, shown in gray at the bottom, is mostly unchanged since the fall and modestly lower compared to the start of the year. And that tells us analysts see some near-term impact from the conflict, but they aren't forecasting a significant earnings collapse in Q1. What I find more compelling here is the trajectory for Q2, Q3, and Q4. Those estimates have continued to trend higher over the past 6 months. Companies and analysts are projecting earnings growth in the back half of the year, an indication that the market views the impact of the conflict as contained and temporary, not the beginning of a structural earnings decline. So the takeaway I want you to leave with from this slide, at least, is the market volatility you've experienced this quarter reflects uncertainty about oil, inflation, and Fed policy. It doesn't reflect a view that American businesses are broken or that a recession is imminent. Earnings are rising, margins are healthy, and companies are beating expectations. When we put current valuations against the earnings trajectory, the market looks reasonable. Not cheap, but not stretched in the way it was at the start of the year. The key near-term catalyst will be Q1 earnings season, which kicks off obviously in April, which is we're now in, so it's going. Companies will be providing the first round of guidance that fully incorporates the conflict during this period. So if management teams maintain their expectations for the back half of the year, the current pullback could represent an attractive entry point, rather than a fear factor. If guidance turns to cautious, the earnings estimates on the right side of this chart may need to come down a bit, but that may change the assessment here. But we'll be watching it closely. So looking ahead, what are the key themes to watch over the next 6 months? So let's bring everything together and talk about what we're watching most closely over the next 6 months. And I don't think these are any surprises, but there are 3 interconnected themes I believe will drive the markets. And they've been woven through almost every slide in the presentation. So theme 1, of course, the Middle East conflict and oil prices. This is without question the most consequential near-term variable. The U.S.-Iran conflict has sent oil from the 60s to $100 a barrel, as we know, and the Strait of Hormuz, again, handling roughly 20%. Global oil remains effectively closed. I mean, there's been further development since the end of the quarter. It's moving quickly, but so this is the most significant oil supply disruption in decades, and its ripple effects will touch everything, So the central question again is duration. If the conflict moves towards resolution, oil prices could normalize relatively quickly. So again, forecasters project that a reopening of the strait could bring oil back to the 70s by mid-year, which would be meaningfully reduce the economic headwinds we face. Iran did signal willingness to negotiate. That's been all over the place, as we know. But it's worth taking seriously. So if the closure persists through the summer, elevated energy costs will likely translate into higher inflation, fewer rate cuts, and a more challenging environment. So we will be watching that closely, as I'm sure the financial media will not let you forget. Theme 2, AI disruption. Ongoing story, separate completely from the geopolitical noise, but the longer-term investment challenge of AI disruption is still playing out. The software industry has fallen nearly 30% as investors, reassess which businesses are genuinely vulnerable to AI, literally replacing their core value proposition. So the sell-off is stabilized for now, but underlying question remains: will AI enhance these existing businesses or just disrupt them? So it's a multi-year theme. It's not a one-quarter event. The market will be watching closely as new AI models are released, as companies begin to report on their own AI strategies, and as some early winners and losers start to emerge with more clarity. So for portfolio construction purposes, though, we continue to believe that diversification across sectors, of course, is the most effective way to navigate all this AI uncertainty. We don't want to be overexposed to the corner of the market most vulnerable disruption, but we also don't want to miss the significant opportunities that AI is creating in semiconductors, infrastructure, energy, and other areas. So, and theme 3, finally, is, of course, Federal Reserve policy. The Fed held rates steady at January and March, has effectively told markets the path of rates depends on what happens next. So, as we know, the market entered 26 expecting 3 cuts and is now pricing in maybe 1 or none. So this Fed's next move will depend on whether this oil-driven inflation pressures, prove temporary or persistent. So, whether energy costs pass through to broader consumer prices and whether the labor market remains healthy. So, the irony of the current situation is that the underlying economy is actually in really good shape. Services are expanding. Manufacturing has returned to expansion for the first time in years, and earnings are growing. So the problem isn't the economy. It's that a geopolitical shock has complicated the Fed's ability to cut rates, which was a tailwind coming into the year. So putting it together, if I had to distill the key message from everything we've covered today, it would be this: the market decline you've experienced this quarter reflects elevated uncertainty, not fundamental economic deterioration. Corporate earnings are growing, economic activity is expanding, credit markets are stressed but not breaking, and the valuation of the S&P 500 has improved meaningfully. So the path forward depends heavily on the resolution of the Middle East conflict. If oil normalizes, again, I know I'm a broken record, but many of the headwinds we've been talking about will probably fade quickly. So what we don't want to do is abandon the discipline, of course, of a long-term diversified approach because of a quarter of geopolitical volatility. History is very clear here. Investors who stay the course through these episodes of uncertainty, maintaining diversified portfolios, rebalancing when appropriate, and focusing on earnings fundamentals rather than daily headlines are the ones who are best positioned for what comes next. And for our clients, I'm sure you've seen your portfolios and they've held up really well considering all of the things we've been talking through. Diversification has absolutely worked this year, particularly in areas outside of your technology-related stocks and even the S&P 500. If you look at small capitalization stocks, international stocks, all doing very well. And so our portfolios have remained very durable. As always, we appreciate your trust, that you place in us, and we're working hard every day to navigate these markets thoughtfully on your behalf. I really want to thank you guys for joining us today. And as always, please don't hesitate to reach out to the team or me directly should you have any questions. Thanks, guys. We'll talk soon.